The markets deliver a week-ending comeback. Are there signs for continued strength or caution ahead? What investors need to know at the opening bell. Squawk on the Street, today, 9 a.m. Eastern. Watch or listen live on the CNBC app.
The Senate passing President Biden's $1.9 trillion spending bill, clearing the way for a House vote this week. But some Democrats say it's not enough. Republicans say it's too much. We've got the details straight ahead. On edge, investors grapple with surging bond yields as growth stocks struggle to make up for what's been a lost year to date. And oil in crisis, yet another major rocket attack in the Middle East, this time targeting Saudi Aramco's oldest and largest refinery in the region. Oil prices are surging. We'll break it all down with what it means for your money. The second hour of Squawk Box begins right now.
Good morning and welcome back to Squawk Box right here on CNBC. I'm Andrew Sorkin along with Becky Quick and Mike Santoli. Joe is off today. Take a quick look at U.S. equity futures at this hour. Let's show you where things stand. The Dow off about 8 points, 7 points right now. NASDAQ off about 186 points, however, and the S&P 500 looking to open down about 20 points. A couple big headlines to tell you about at this hour. Shares of GE, they are higher in pre-market trading. This after the Journal, Wall Street Journal that is, says that GE is close to a deal to merge its aircraft leasing division with Ireland-based AerCap Holdings. It would be the latest in a series of moves by GE to restructure its holdings and strengthen its balance sheet. Meantime, California is going to allow Disneyland and other theme parks in the state to reopen. That's going to happen on April 1st. However, their capacity will be severely limited at first, and of course, strict COVID-19 safety protocols will need to be in place. Theme parks and stadiums in the state have been closed now for nearly a year due to the pandemic. And earlier, we told you about Q Health's new COVID test, and there's another one in the news right now. Check out shares of Adaptive Biotechnologies. They're surging after the Seattle-based company received emergency use authorization for its own COVID test. This test can tell patients not only if they've had a recent COVID-19 infection, but also whether they've ever been infected. So watching that stock up now about 11%. Mike?
All right, well, this week marks 1 year since the world changed when the WHO declared COVID a global pandemic. We have two stories looking at the next chapter when it comes to debt and the economy. Steve Liesman on the outlook for growth. But we begin with Ylan Mui on the record amounts of money being deployed to combat the effects of the virus. Ylan.
Well, good morning, Mike. It is so easy to forget the sheer magnitude of fiscal support that we have seen over the past year. But there were 5 bills signed into law, $4 trillion in spending, and a new record for red ink. We've spent $1.7 trillion on loan programs alone, like the PPP and support for airlines. Another $673 billion went toward income support. Think unemployment insurance. $472 billion went directly to testing, vaccines, and other measures to fight the virus itself. And we've sent $458 billion directly to the American people in the form of stimulus checks. And together, that has helped drive the national debt to equal the size of the economy. And if we stay on this track, it'll be double GDP in 2051, blowing all previous records out of the water. Now, that doesn't even take into account the $1.9 trillion COVID relief package that is currently working its way through Congress. When you add that to the mix, the pandemic response will total 4.6% of GDP. For comparison, the response to the Great Recession was just 2.4% of GDP. Now, as the debt has piled up, the political will for more spending has dwindled, guys, leading to the kind of party line votes that we're getting now. Back to you.
Ylan, thank you very much. Now to Steve Liesman and whether an economic crisis has, in fact, been averted. Steve.
Yeah, Mike, government relief is famous for coming too late in a crisis and often being too small. Not this time. The federal government, as Ylan just told us, in 5 separate bills, here's another way to look at it, pumping $4 trillion into the economy last year and now looks likely to issue an additional $2 trillion of aid. Those are the 4 big ones. The fifth one, the early one, at $8 billion is missing. Most economists agree. The result was not only to help turn the economy around, but to avoid far worse outcomes. After crashing 33% in the second quarter of 2020, growth came back by an unexpectedly strong 31% in the third quarter. There were business reopenings, but a huge impact came from government flooding the economy with cash. Economists had initially forecast half the third quarter growth we got and ended up being wrong in part because they were surprised by the speed and the size of the fiscal response. The Fed in June, they'd forecast a 6.5% decline for 2020, and then it ended up being down 3.5%. The current impact of that large spending. The economy is in better shape for the turnaround. We have a high savings rate, and that's going to help spur future consumer spending. But there are questions about inflation, the deficit, and whether indeed more is needed in that $2 trillion package. What's clear is that the rulebook has been rewritten for government responses to future crises, to go big and to go early. The U.S. economy forecast to grow more than 6% this year. That's a result of the prior bills and the current relief package. What's not been embraced is the rule that one should reduce deficits in better times to prepare for worse times. And what we will find out through the bond market and the inflation numbers is whether there is a limit on just how big you can go. Mike?
Yeah, and Steve, I mean, as you suggest here, this has been a real-world experiment in a lot of activist fiscal policies many people have advocated for a while, and a lot of people feared for a while, I guess, depending on where you're coming from. With it all in the mix, we had Nancy Lazar earlier saying 8-9% GDP growth possible for this year, something none of us has really seen in almost 40 years. What do you think that means? I mean, we have to ask about the Fed here, whether, in fact, they can look in the face of this type of powerful growth and stand pat.
I think the Fed has told us it's going to be watching the jobs numbers, and this is a big change. Usually the Fed is saying, hey, we're watching the dual mandate here. They don't think that inflation is going to be a huge deal. They think the inflation numbers are going to be temporary. We know there are supply disruptions. We'll talk about that more this week. We also know that there are issues in terms of commodities and all sorts of prices that are out there. But the idea the Fed believes that's temporary. They're going to try to look through it. It's going to be tough, and we'll see if Powell can really hold the line. But until those jobs numbers come down and without massive inflation, I think the Fed has a tolerance for 2.5 to 3%. I think they're going to hold the line, Mike.
Hey, Steve, I bring this up just because Mark Grant said it. This is kind of a related question, but Mark Grant said it in the last hour. He said he thinks the Fed is going to have to do something because of what Ylan was just reporting on, this big package, $1.9 trillion, the amount of money that's now being spent, and what we will have to pay if you see interest rates continue to tick up like that. He says, look, they're going to have to do it just to make sure that we're not paying back too much in interest. I know we never say that things like that enter the Fed's line of thinking. They've got the mandates, they've got the things that they look at, but what about just the realities of when you spend this much money, if interest rates go up and you have to pay it back at much higher rates or even slightly higher rates, that money adds up pretty quickly. Is that something that will be discussed?
I don't think they'll discuss it publicly. I think they'll whisper if they talk about it privately. What's the right word? The mantra is that the Fed is not going to be doing asset purchases because it's going to try to keep down the amount that's paid by the federal government. Whether that actually enters into their thinking, I think it's a part of it. I think, though, Becky, if you had a situation where you had very, very strong inflation I think in that case, the Federal Reserve would not be in a position where it would continue its very easy monetary policy. I believe the Fed, in a low unemployment but a high inflation environment, would turn its attention towards inflation.
Ylan, you mentioned that the appetite for further fiscal spending initiatives might be diminished here after all that's been done already, but the conventional wisdom was that infrastructure had a really good shot because there might be bipartisan support. Has that changed given the size of what's already gone through?
I think that could possibly change, Mike. I think that what we saw was Joe Manchin getting uncomfortable with the size of the package and the amount of support that was going to individual Americans. And so Democrats were forced to scale back some of those measures. So I think that says a lot about how big they're willing to go in an infrastructure package, especially if some of these economic forecasts bear out and we see 8 or 9% growth, as you were mentioning. So I think a stronger economy could make it harder for Democrats to pass a $2 or $3 trillion infrastructure package as they had been discussing at one point. So I think that the economics do play into this as well. And I think it's going to be very difficult for them to make the case that you need to do things like extend unemployment insurance or have additional rounds of direct checks if we see that kind of growth actually come through.
Yeah, a lot of it maybe ended up being front-loaded. Ylan and Steve, thanks very much. Talk to you soon.
Pleasure.
When we come back, Bank of America's Savita Subramanian says that markets are nearing a sell signal. We're going to dive into why she thinks returns may be tepid in the coming months. But before we head to a break, news just in of an all-stock merger between private equity firm Apollo Global and retirement services company Athene Holdings. Both of them up in the pre-market trading. Athene Holdings up by 14.5%, but Apollo's up too. It's up by 5.4%. Squawk Box will be right back.